Ravi is joining us on the show today he's the head of equities and CIO at Principal. Ravi, good afternoon. Thank you so much for your time. How are you analyzing the investing landscape, and what's your own framework right now with this kind of a big rally as far as large caps are concerned? Mid caps have now started coming up. Are you broadening your radar as well?
Yeah, good afternoon, and thanks for having me on the show. No, absolutely. I think, ever since COVID and the massive volatility that we saw, I think this market has, basically all the sectors have actually participated. I mean, whether it is all the segments, rather, whether it is large cap, mid cap, or small cap. And initially, it was generally the quality that was participating. And then, obviously, as the valuations kept moving up, the rally expanded and became much more broad-based. But certainly, I think, as you rightly said, it's the huge inflow of money from the FIIs that is actually keeping the markets up. And, we suddenly saw almost a 12% gain in the last 1 month or so. And thanks to the foreign liquidity. Although, domestic funds have been net sellers on the other side. But despite that, the post-election, the inflow has been extremely strong. So that's the reason why we are seeing the markets at such a level.
Ravi, I see your portfolio. As far as the Principal emerging blue chip is concerned, you've got pretty interesting holding towards the Atmanirbhar kind of plays. Dixon, Navin Fluorine. So it's all started with electronics, but now with new PLI schemes being announced, it is going towards pharma, chemicals. How are you reading the government announcements and this entire PLI opportunity for which sectors?
Yeah, in fact, it has been extremely interesting. If you actually see the policies that the government has been framing over the last 2 months, I'm not talking about last 2 years, rather, not in the last 6-8 months. It's been, pretty much guided towards bringing back manufacturing into India. And that's the reason why you saw, a huge tax relief for people investing into new capacities last year, where the taxation rate is as low as about 15%. So that was the first move. And then, of course, the PLI into the electronics side of it. And one of the main reasons why that was done, again, is, India's electronic imports, particularly mobile phones, the size of imports had actually crossed oil imports, the oil import bill. So that effectively is a very worrisome kind of trend. And, and in order to kind of, put a cap on that, there was only one option to incentivize domestic production. And through the PLI scheme, I think the government perhaps has achieved, some success, because a lot of global players have evinced interest into setting up manufacturing into India. Now, this could have taken probably much longer had COVID not happened. Now, because of COVID, I think there is an increasing amount of, effort to kind of, de-risk from China and look at other countries. And I think India really fits the bill. And it's not, just because of these incentives or any of that. And even in terms of core competence, even in terms of, the cost of manufacturing, whether you talk about labor, power, I think India is reasonably, quite efficient. But where India is not efficient is the size, because, size gives you that, or scale gives you that, edge in terms of costing. And I think that differentiation is what's being plugged by the PLI schemes. And, as the government has already stated, it has rolled the PLI scheme to, an additional 8 or 10 sectors. And these are areas where, India has particular core competence, whether it is automobiles, whether it is chemicals, pharma, electronics, several such areas. So I think, it's a very good strategy. It might take time. It's not, that something is going to happen overnight. But certainly over the next 2 to 3 years, you will see a huge amount of manufacturing, opportunities within India, and some of it obviously will be some share taken away from China.
Ravi, how are you playing banks? I mean, I see some of the large banks in your portfolio, both retail-oriented private sector as well as corporate rated private sector in the form of HDFC and ICICI. I want to know, are you incrementally looking at mid-sized banks as well, where the concerns on NPAs were elevated, say, a couple of months back, but now it appears that it may not be that bad, the situation. Even some NBFCs in the same light, which have rebounded very sharply as those concerns have got abated?
Yeah. So, if you see, look at our portfolio maybe 6 or 8 months back, I mean, since COVID, we were pretty much on the retail private sector banks. And we had reduced our weightages in most of the NBFCs and the smaller banks, etc. But last couple of months, we've been adding to our positions. We were underweight banking 2 months ago, but now we are overweight banking. And most of that overweight has actually come from, some of the private sector banks and also some of the NBFCs. And insurance was something which was always, a pretty steady business for us. So we had significant overweight there, and that's played out extremely well. But NBFCs, were the dark horse, where the risk reward started to become a bit more favorable as we realized in our conversations with the various corporates in that space that, seemingly things are not so bad. The impact of COVID, probably won't be so bad. So that's when we started adding to some of those positions. And that's why we continue to now see an overweight position in terms of the banking and financial services, side of the portfolio. To your question in terms of, the mid-size and the small size portion of the banking, we're still waiting and watching, although we have a couple of positions there. We aren't adding any new positions, at this stage, but certainly watching that space, because typically, mid and small size banks, you want to kind of see those numbers, consistently come off, before you kind of make further commitments.
Mm-hmm. Ravi, how are you playing pharma? I see one large, I would say, country's largest API company as your top holdings. Very good margins. I think it's at all-time high, if I'm not wrong. But how are you playing pharma and chemicals theme beyond the large cap ones?
Yeah, so pharma, again, it's more of a bottom-up kind of philosophy there, because, we have to look at, company by company, who are the best placed pharma companies. So again, initially we thought we will play with the domestic players, and that played out really well. And then slowly we started diversifying away from the domestic players into the more international pharma players. And one of the main reasons is, whatever is happening on some of these sectors, whereby, the outsourcing story is playing out reasonably well. And with the US FDA approvals, coming in faster compared to what we saw in the last 3 or 4 years, I think it's a great opportunity for Indian pharma companies. And some of the stocks there, again, have excellent potential from a longer term perspective. Yes, in the near term, they've all run up quite a bit. So perhaps we might see some consolidation out here as the market, is going through a sector rotation, as is very, very evident that some money is being taken out of, the slightly more defensive, so-called more defensive stocks like FMCG and pharma, and moving into financials, industrials, and thereabout. So I think as a result of that, you might see some consolidation in the pharma sector for the time being, but certainly over the next 2 to 3 years, I think, perhaps next to China, other than India and Israel, we don't see any other countries competing in that space. So even if there is and let's put it this way, China is 10x in terms of manufacturing capacity, even if 5%, let's say, moves into countries like India, I think that's going to give a massive shot in the arm for manufacturing of both APIs as well as formulations.
Okay, right. All right, Ravi, we'll let you go on that one. Thanks so much for joining us on the show. Look forward to having you more often from here on.